Bismillahirrahmanirrahim. This video is about the process by which central banks create money and how governments spend. So let's say there is a government which wants to purchase an aeroplane, and that plane costs $100 million, and the government doesn't have enough resources to buy that plane. So how does it go about funding this purchase? So typically this happens in two steps. In the first step, the government issues a T-bill or a bond to the private sector, to private banks or primary dealers. And then in step two, the central banks would purchase those bonds or treasury bills from the private sector in an open market operation. But just to simplify the process and to make it simple to understand, let's assume that those two steps are merged into one step and that the government is issuing a bond directly to the central bank. And let's see how it works. So in step one, let's say we have the balance sheet of the government here, and we're starting with 0 assets and 0 liabilities. So in step one, the government issues a bond. The government issues a bond worth $100 million and to the central bank, and the central bank basically just creates just buys this $100 million bond as an asset and just creates that deposit or cash reserve out of nothing. So just through keystrokes, the central bank creates $100 million and basically gives it to the government. So the government has cash reserves of $100 million now. And of course, the government also has a liability of $100 million, which is in the form of the bond. Okay. So this is the step one. This is the issuance process. So the government has issued a bond, which is a liability for the government. And then the central bank has purchased this bond. So this becomes an asset for the central bank. And then of course, just to balance the balance sheet, and we have a rule called loans create deposits. So this loan extended by the central bank has created a deposit, a reserve for the government, which is as good as cash. And this deposit can be used for purchasing and spending on goods and services. So that's the step one. So let's say the seller of the aeroplane has an account with Bank of America, and now the government, since the government has cash, now the government is going to use the cash to purchase the aeroplane. So how it would do that is it would pay this cash to Bank of America, and Bank of America would basically credit the account of the seller of the aeroplane. So how would that happen? Let's say this is the seller of the aeroplane, and this guy would have $100 million in his account. And now this deposit, which was in the name of the government, will now be in the name of Bank of America. So these are the reserves. These are reserves, and these reserves are of course as good as cash, and these are in the name of Bank of America. So earlier, this liability, this deposit belonged to the government, But now since the government is paying for the aeroplane, so this liability of the central bank is towards the Bank of America and is not towards the government. So that's how that is settled. So once this deposit is transferred, the government no longer has the cash reserves, but the government has the plane. Okay, and Bank of America will have these reserves. So $100 million reserves. So it will have reserves of $100 million. And that's how all the balance sheets tally. So just to summarize now what happened, the government now has an aeroplane worth $100 million. It has a liability of $100 million. This liability is an asset for the central bank because the bank produced this cash and purchased this bond of $100 million. And then initially this reserve or this deposit was a liability towards the government. But once the government purchased the plane, this deposit or this reserve is a liability towards Bank of America. It's not towards the government anymore. And so yeah, so that's the deposit, the reserves, and of course the Bank of America can use these reserves to extend loans and further expand the money supply. And the Bank of America's balance sheet, it has $100 million as reserves at the central bank. And in terms of the liabilities, it has the $100 million in the checking account, in the current account of the seller of the aeroplane. So the seller of the aeroplane has $100 million cash. Bank of America has $100 million cash, which is deposited with the central bank. And then, of course, there is an asset of $100 million and liability of $100 million corresponding. So everything cancels out, and basically the net effect is that $100 million have been created. Now the value of deposits now, so the way the money supply is calculated is by looking at the deposits in the commercial banks. So Bank of America has deposits of $100 million, and this is also called as the M1 money supply. And that money supply has been expanded by $100 million. And this all happened out of nothing, basically. The central bank has created money out of nothing, and the money supply has expanded by $100 million. So that's how central banks create money, and that's how the government spending on the aeroplane, for example, that's how the government spending leads to an expansion of the money supply. So I hope that's clear. If you have any questions, please let me know in the chat box.